Let me start by asking you to do something simple. Look at these company names for just a second. Eli Lilly, Micron Technology, Vertiv Holdings, AppLovin, Broadcom, Capital One, Comfort Systems, Corning, Western Digital, Amphenol Corporation. At first glance, these companies do not look like they belong together. They are not from the same sector, they are not part of a single team, they are not connected by hyper headlines, and yet they are grouped together inside a brand new ETF that most investors have not even noticed yet. Let us take a step back first. Most investors today rely on passive ETFs, and to be clear, there is absolutely nothing wrong with that. ETFs like VOO, which tracks the S&P 500, are designed to give you broad exposure to the largest US companies. It is simple, low cost, diversified, and proven over decades. Then you have QQQ, which tracks the Nasdaq 100. It is more growth focused, more tech heavy, and more volatile, but still completely passive. You also have VUZ, the Vanguard Growth ETF, which spreads exposure across US growth companies, and VZT, which concentrates heavily on technology and tech-driven businesses. All of these ETFs are excellent long-term core holdings. They are reliable, they are predictable, they are easy to hold. But here is the part that rarely gets discussed. Passive ETFs are designed to own the market, not to chase where growth is accelerating right now. They follow rules, they rebalance on schedules, and they wait for companies to become large enough. By the time a fast-growing company becomes a meaningful weight inside a passive ETF, a big part of the explosive growth phase may already be over. Passive ETFs are great for stability, but they are slow to adapt. Markets, on the other hand, move fast. Earnings leadership rotates, momentum shifts, and capital flows change direction. And that is the gap this ETF is trying to fill. This ETF does not track an index. It does not care about market cap thresholds. It does not care about sector weight limits. It does not even care whether a company is classified as tech, healthcare, industrials, or financials. What it cares about is earnings growth relative to the market. That is exactly why this ETF has already delivered close to a 40% gain since its launch in August 2025. Over the same period, well-known ETFs like QQQ and VZT have posted single-digit gains, with QQQ up under 8% and VZT lagging even further behind. That gap highlights the difference between dynamic earnings-driven rotation and traditional passive exposure. This ETF uses an active, quantitative approach to identify companies showing strong earnings growth, improving fundamentals, and market confirmation through price behavior. Instead of holding hundreds of stocks, it holds roughly 25 to 30 companies. That concentration is intentional. The goal is not to mirror the market. The goal is to lean into what is working. Now here is where things get really interesting. This ETF is not just active, it is highly dynamic. While researching and creating this video, I kept checking its holding repeatedly over several weeks, and what I noticed was something you almost never see in traditional ETFs. The leaders were changing constantly. Let me give you real examples from my own research. At one point, Micron Technology was sitting at the very top of the portfolio. Clear earnings momentum, strong demand signals, and strong market confirmation. A few days later, Eli Lilly moved into the top position as healthcare earnings strength started dominating. At the time of recording this video, Eli Lilly is now the largest holding. Just a week ago, companies like Palantir, AppLovin, and Amphenol were comfortably inside the top 10. But now, you see names like Corning, Vertiv, and Broadcom moving into top positions. This ETF is not emotionally attached to stocks. It does not wait, it responds. Another key thing to understand is that this ETF does not think in terms of sectors. It thinks in terms of earnings behavior. You can loosely group its holding into categories, even though the ETF itself does not label them this way. You have semiconductor and infrastructure enablers like Micron, Broadcom, and Vertiv, which benefit when data, AI, and infrastructure demand accelerates. You have healthcare earnings leaders like Eli Lilly, which rise when pricing power and earnings visibility dominate. You have software and data-driven companies such as Palantir or AppLovin, which perform well when operating leverage and revenue acceleration matter. And you have industrial and component specialists like Corning or Amphenol, which benefit from capital spending cycles. The ETF does not predict which category will win. It simply follows the earnings strength wherever it appears. Why daily rotation matters? This is something passive ETFs cannot do. Passive ETFs cannot remove a stock because earnings momentum faded last week. They cannot promote a rising earnings leader immediately. They wait for rebalancing schedules. This ETF does not wait. If leadership shifts from tech to healthcare, it shifts. If leadership rotates from software to infrastructure, it adapts. If yesterday's winner becomes today's laggard, it gets reduced or removed. That is why the holdings you see today are not the same as the ones you saw a week ago. And that is not a weakness. That is the strategy working exactly as designed. A quick check-in with you. If you are enjoying this breakdown so far and finding it useful, please take a second to like the video and subscribe to the channel. It genuinely helps this channel reach more investors who want deeper, research-driven content like this. And it tells the algorithm that this kind of analysis is worth sharing. If you know someone who loves ETFs or growth investing, sharing this video helps them too. Alright, let's keep going. This ETF is not trying to replace VOO or QQQ. It is not designed to be your forever hands-off investment. This is an ETF for investors who understand that markets move in phases and earnings leadership rarely stays in one place for long. Think of this ETF as a real-time reflection of where earnings strength is flowing inside the US market. If this concept sounds familiar, that is because I recently covered another new ETF with very similar characteristics. That ETF also focused on active rotation, momentum, and earnings strength, and it delivered some impressive early returns. If you missed that video, I highly recommend checking it out. The link is in the description. Seeing both ETFs side by side really helps you understand how this new generation of active ETFs is evolving. So now that you understand how dynamic this ETF really is, now that you have seen how the holdings rotate, and now that the strategy actually makes sense, it is time to reveal the name. This ETF is SGRT, the Smart Earnings Growth 30 ETF. SGRT is an actively managed equity ETF that launched in 2025 or August 2025. It holds approximately 25 to 30 US companies at any given time. Its objective is long-term capital appreciation, not income. It is not meant to replace your core holdings. It is designed to complement them. SGRT exists to do one thing very well: follow earnings leadership as it shifts. Now let us talk honestly about risk. This ETF is more concentrated, so individual stock performance matters more. It is actively managed, so manager decisions matter. It is newer, so it has not been tested across multiple market cycles. And because it focuses on earnings momentum, sharp market reversals can create volatility. This is not a low volatility fund. This is a growth tool. This ETF is for investors who already believe in passive investing but want something more dynamic layered on top. It is for people who want exposure to earnings growth without being locked into a single sector. It is not for investors who cannot tolerate volatility, and it is not meant to replace your entire portfolio. Passive ETFs like VOO, QQQ, VUZ, and VGT will always have a place in long-term portfolios, but markets are dynamic. Earnings rotate. Leadership changes. SGRT exists for investors who want exposure to that reality. So my question for you is simple. Would you rather own a snapshot of the market, or would you rather follow where earnings power is actively shifting? Let me know in the comments. And if you want more deep dives into new under-the-radar ETFs like this, make sure you are subscribed because more are coming.